Embracing losses, a key to successful investing. Investing in the financial markets can be a roller coaster ride, filled with both gains and losses. However, many investors struggle with the concept of accepting losses and tend to hold on to losing positions in the hope of a rebound. In the next few minutes, we will explore the counterintuitive idea of embracing losses and how it can lead to better investment outcomes. The human response to losses. When faced with a loss in their investment account, the natural human response is to hold onto the position until it recovers or breaks even. This mindset stems from the fear of realizing a loss and the desire to avoid the pain associated with it. Unfortunately, this approach often leads to even greater losses as the investment continues to decline. The recipe for disaster. Holding onto losing positions in the hope of a turnaround is a recipe for disaster in the world of investing. More often than not, the investment will continue to decline, resulting in a permanent loss of capital. By refusing to accept small losses, investors deny themselves the opportunity to cut their losses and move on to potentially more profitable ventures. Falling in love with losses. To break this destructive cycle, it is crucial to train oneself to fall in love with small losses. This may sound paradoxical, but it is a mindset shift that can significantly improve investment outcomes. By accepting and embracing small losses, investors protect themselves from the potential of experiencing a significant loss. Taking immediate action. As soon as a small loss occurs, it is essential to take immediate action and exit the trade. By doing so, investors prevent the small loss from snowballing into a larger one. This proactive approach ensures that losses are contained and do not erode the overall investment portfolio. Avoiding big losses. The key to successful investing lies in avoiding big losses. By consistently taking small losses, investors eliminate the possibility of experiencing a catastrophic loss that can severely impact their financial well-being. This strategy allows them to preserve their capital and focus on identifying opportunities that have the potential for significant gains. Trading with realistic expectations. Another way to embrace losses is by engaging in trades with realistic expectations. By setting clear objectives and understanding the potential outcomes, investors can mentally prepare themselves for either a small loss or a big win. This mindset shift helps to remove the emotional attachment to losses and allows investors to make rational decisions based on their predetermined trading plan. Conclusion. In the world of investing, embracing losses may seem counterintuitive, but it is a crucial mindset shift that can lead to better investment outcomes. By falling in love with small losses and taking immediate action, investors protect themselves from the potential of experiencing significant losses. Additionally, trading with realistic expectations helps to remove emotional biases and allows for more rational decision-making. Ultimately, by accepting losses as a part of the investing journey, investors can position themselves for long-term success.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.